Fair enough. We will start this session. So welcome you all. Good afternoon. This session is primarily going to be on couple of applications within the Excel, primarily a financial and statistical application. This is just a gist of it. It doesn't cover the entire. Uh, it doesn't cover the entire amount of all the statistical functions. This is just a gist of it, and we will try to cover whatever important and relevant as a part of our day-to-day activities. Before that, I'll introduce myself. I am Parth, as I'm part of FinShiksha. A brief background about myself. I am basically a pass out of Narsimonji, and I've worked with institutions like Fidelity Investments, ICICI Wealth Management, Accenture, and have experience in risk and wealth, and primarily on the equity side of it. So that's pretty much about myself. This session we will have it for an hour or so. We will start with the basics of financial functions, which we usually hear, but maybe we haven't used it extensively. Uh, so that's the basic premise which we are going to cover as a part of this session. So over here, the first thing which we are going to do is the time value of money. It's a basic concept in finance like present value, and find out the future value of investment or money which we have or which we want to grow after a particular period of time. So that's the concept of time value of money. Over here we have taken an example, says that amount every month I have 20,000. For years, which is 2, so I have to invest this 20,000 for 2 years, and I'm expecting a return of 15%. Fair enough. So over here, I want to find out if I invest 20,000 every month and I am generating 15% return, which is annualized return, then how do I, or what is the amount of money I will have at the end of the 2 years? Okay, so over here we will do both the methods. One, without using the formula. Second, with using the formula. So over here I will start with this 20,000 amount, which is equal to B4 cell. I will give a reference to B4 cell, which is a 20,000 over here. Amount grown after first month, which is equal to 20,000 into 1 plus 15% divided by 12. Since this 15% is annualized, I am dividing it by 12 so that I get a fair amount of return every month, which comes out to 2250. I will convert this into a number format or with the colon applicable. Fine. Then at the next month, I will have this 20,250 plus 20,000 invested, and I will make this as a constant because every month this 20,000 will get added. Fair enough. This gets to me 40,250. My growth, I will just drag this down to a 24, and okay, something needs to be made constant. So over here the returns needs to be made constant because I am dragging this down. So this is the output which I have get. So it says at the end I will have 5.62 lakhs after 2 years. I will repeat myself. Don't worry. I will repeat myself. Don't worry about it. So it says that I have 20,000 in the first month. Every month I will have 20,000 extra amount to add as a part of my investment portfolio or investment decision. Now it says that I have 15% growth rate, or as in 15% as a part of my total return annually. Okay, and I have to invest 20,000 for 2 years, so which has 24 months. So I have jotted down first to 24, which is 24 months. I will invest this 20,000 every year. If annually I am getting 15%, then monthly the percentage will I'll get would be 15 by 12. So I've divided by 15 by 12, and I've added one to it because I will get 20,000 and 15% to it. So which is, if I do it separately, 15% into 20,000, which will come to 250. So overall amount which I'll get is 20,250. Fair enough. And then I've just added this amount till the end. I will just drag it down till the end to get output as 5.62 lakhs. So this is a traditional method. Just think of it, if you have a 360 month period kind of a thing, or a 30-year kind of a period, then you have to drag this like for 360th period, and this is a tedious task. Instead of that, Excel has a beautiful formula called as FV, which is like a future value. We have studied this in finance. It's just that the application part for some of you may be missing. So that's what we are trying to cover over here. So when you write FV, so any formula in Excel starts with equal to, write FV, it gives you the future value. You just click on it or press tab. It will open a bracket. The first input to this formula is my rate, which is 15% divided by 12, because I am investing every month. So I want to convert my returns to a monthly return. So that's why I've divided it by 12. Had it been a yearly, I am calculating yearly, then I will not interfere it by dividing it by 12. I will simply write it 15. The second input is number of time periods. Over here, there are 2 years. I will again convert this into a month, which is multiply by 24 or multiply by 12. So 2 years multiply by 12, convert it to a 24 month. Third input is my per month or payment made in each time period, which is 20,000 over here. Okay. So first three inputs are mandatory inputs, which is rate, number of periods, and the third is payment made at each time period, which is PMT. Now the fourth and fifth option is an optional. So fourth option is a present value. So let's say I'm investing or I'm calculating at the age of 30, but at the age of 30 I have 10 lakhs accumulated already, which is the present value now. Then I can put 10 lakhs over here. If I'm starting a fresh, I don't need to put anything. By default, it will take 0. It's a non-mandatory field kind of thing. I will press comma again. And the last option is, when are you doing your investment? At the start of the period or the end of the period? So by default, if I don't put anything, it will automatically take 0. I'll close the bracket. It says 555761. It is the output over here, and at the end of the year I will get 5.62 lakhs. So you can see 555761.68 has been mentioned over here. It comes out negative because it assumes that you have to pay. Instead of, you can put negative over here. So my concept of this is, if it's a cash outflow in any sense, put it negative. So over here, when I'm putting my present value or my PMT, is a cash outflow for my so when I'm putting cash outflow, it's a negative for me. That's why I've put a negative, and at the end of my 24th month, I will get B4, which is 20,000 every month. So accumulated would be 5.55 lakhs which is over here, and at the end of that 24th year, I will get 5.62 lakhs. So there's a question. There's a question which says that somebody is getting an error. So over here, someone who is getting an error, you have to press B1 multiply. You cannot directly open in bracket. So Excel doesn't understand that. You have to multiply. So over here, there's a multiplication sign. If you remove this, Excel will throw an error. You can't remove that. You have to press multiplication error. You have to put a multiplication sign to remove that error. So I hope I have answered your question. Fair enough. What if I put 1 instead of 0? So if I put 1, my answer is exactly the same as 5.62 lakhs. Okay, which is at the start of the period. So whatever we have calculated over here is the fact that we have considered that my investment will happen at the start of the month and not at the end of the month. Okay, so that's the difference between putting 0 and putting 1. So 0 means I am putting my investment at the end of the month. So for let's take an example: 2011, 2012, 2013. I am calculating for these 3 years. If I put 0, then it's assumed that I have made investment at the end of 2011, which is the start of 2012, which is the start of 2012. If I put 1 over here, it automatically assumes that my investment is at the start of 2011. So there's a difference between 1 year. The difference of 1 year. 1 year means there is a gap of 15%. Okay, or there's a gap of 1 month. So that's why you see the difference in answers over here if I put 0 or 1. I hope I have answered your questions. Any questions in this FE formula? Anyone? Anyone? Do you want me to repeat something in this part? Anyone? You can type in your questions, please. You can type in your questions to the questions box. I can see your questions if at all you type it, and I can answer those questions. Okay, I have a question saying that can you explain the 0 and 1 again? And I have another question says that how did you get the amount value by dragging it down? Okay, so you simply have to write this formula. There's a small square box over here. You simply have to drag this. Even if you don't drag this, you just have to double click over here and you will get the answers. Does it solve? Does it solve the purpose? Okay, I have another question says that can you explain what is the difference between 0 and 1? So if you put 0, 0 says that you are making something at the end of period. So Excel also says that if you go here, you delete this, it says end of the period. So if I press 0 and I have 3 years, 2001, 11 and 12. So if I put 0, it says my investment started at the end of 2011, which means my investment started in the first month of 2012. Okay, end of 2011, which is the start of 2012. Fair and straight. If I put 1, it directly assumes that my investment started in 2011, first month of 2011 or first period of 2011. So there is a gap of 1 period between 0 and 1. That's why you see the difference over here. So if I put 0, in this formula, it assumes that my investment started at the end of my year. Okay, I will explain you how did I drag. Okay, but before that I will finish this concept. So if I put 0, it says 555 is in 5.55 lakhs. So which is at the end of my 23rd year, which is the starting of my 24th year. Okay, and if I put 1, so it says that my end of my 24th year and the starting of my 25th year. So that's the difference of one period between 0 and 1. And this concept is applicable in all financial functions. Okay. How did I drag this? You simply click on the cell C11. There is a small square box over here. Till the time you get this cross, you just move around your cursor. As and when you get this cross, you simply double click this cross and output will be, and you will get the output over here. Okay, fair enough. Okay, in the meantime, what I will do is I will also upload the solved file, or anyways I will email you the solved file so that at least you have the output with you guys. I will I have shared the solved file. You can download that solved file. In the solved file I have not solved time value of money, but I have solved amortization and I have solved the distribution part of it. You can have a look at it. Even if you are not getting it, please let me know. Feel free to ask me questions. Okay, those who are not getting the answer, I will connect with you separately over email, because others are stuck, because they have already solved this. So don't worry about it. I will also share the solved file. Don't worry about it. I have also shared the solved file which has amortization and distribution solved. I will also solve time value of money and I'll send it across after the session gets over. Thank you. Somebody has asked me a question. What if I invest 20,000 in the end of each month? So that's what I've told you. Instead of the 0, you just have to write 1, so that Excel will understand this 20,000 is invested at the beginning of the period. If I write 0, Excel will understand that 20,000 I have invested at the end of the period. So that's the only difference. You don't have to write anything else. You just have to convert the 0 to 1 or 1 to 0. Okay, fair enough. Any more questions? Any more questions? Okay. Now there is another application. Now there is another application, says the amortization. So like FV, like future value, if we want to find out of my present value, whatever is my present value, I want to find out every month what I have to do. So it's more like a loan. It's more like an equated monthly installment or an EMI I have to pay. Okay. So there is a function called as PMT. In FV, we saw some option called as PMT. Over here, we saw the third option, which was PMT, which is payment made every time period. Okay, now if we want to find out what payment needs to be made given the other options. So over here, there is an option called as PMT. Now I have taken another example, says that I have a loan of 10 lakhs with an interest rate of 10% per annum. My tenure is 1 year. What would be my EMI? Okay, I have already created this table. In the handout section, I have already shared the file which you can access it. I have already in that file contains the solved output of this question. So if you are not able to get it, you can access that file and see the formula. I will also solve how to get this and how to solve multiple formulas which is related to this. Okay, we'll start with the first one, which is a PMT, over here. If you have any issues, you can type in your questions. You can raise your hand, you can type in your questions, please. You can raise your hands and type in your questions if you have any questions. Okay, so over here I have a formula called as equal to PMT. Can you see my screen? People, can you see my screen? Just type in yes or no, please. Okay, thank you. Fair enough. Okay. So there is a formula. Okay, screen usually takes a couple of seconds to move. There may be a delay. There may be a delay. Now can you see? All right. All right. All right. Okay. Fair enough. Fair enough. I've got enough responses. Yeah. Yeah. Thank you. Thank you. We will start this again. Okay. So I have a situation over here which says that I have a loan amount of 10 lakhs with an interest rate of 10%, and I have to pay entire loan in 1 year. Okay, which is like a 12 months. Since EMI is a monthly, or which is equated monthly installment, it's a monthly installment. So I have to calculate every month how much interest I will pay, how much principal I will pay, and how much EMI I will pay. Since EMI remains the constant throughout the period. Okay, so there's a formula called as PMT. Okay, which is exactly opposite to FV, or there's couple of options which were part of FV is now a part of PMT as well. The first thing is my rate, which is 10%. Since EMI is a monthly installment, I will convert this rate into month, which is again divided by 12. Okay, tenure is 1 year. So I will convert this into years as well, which is I'll multiply by 12. Okay, my PV is my 10 lakhs, which is a present value of my liability. Since it's a liability, I will make it negative. Fair enough. Future value, I am not trying to reach anywhere. So future value is anyways is optional. And I will start paying EMI after a month. Okay, so at the end of my period, and I will close the bracket. It gives me 87,915.89. So that is going to be my EMI. I will explain this again. PMT, or I will, you can see the formula over here. Okay, which is PMT. First thing is C6 by 12. C6 my interest rate. I will convert C5 or C6 is my interest rate. C6 by 12 I will convert into monthly. Yearly, years also I have converted to months. My loan amount, since it's a liability, I have converted into negative, and I will pay at the end of the month. So I have mentioned it 0 over here. Okay, fair enough. So I will get 87,915.89 as my EMI. Now EMI is same for all the periods. Okay, EMI is same for all the periods, which is over here. I will make this EMI constant. I'll make this EMI constant, and I will simply drag this like this. EMI is constant for all the years. Fair enough. I have to calculate now interest for that particular tenure, principal for that particular tenure, and loan principal amount which is outstanding after I've paid the principal. Okay. So my interest, which is equal to 10% divided by 12, because I will be paying interest monthly. I'm paying interest on my overall loan amount. So I'll calculate interest on my loan amount, which is in the first month I will pay 8,333.33 as a interest. So interest will be on my loan amount. Okay, I will make this C6 constant by pressing F4, and I will keep B11 floating. Why? Because every month I will pay some principal amount and I will deduct it from my loan amount. Fair enough? Principal would be my EMI minus interest. Since my EMI is made up of interest payment plus principal payment. If I have made interest payment, then the rest what is left out is my principal payment as per this formula. So I've simply done that. I will also format this interest part of it. I will drag this. I'll simply have to drag this. For the time being, you will not get the correct output at the end of the 12th period. There's one modification which is required, which is every month I will pay some principal back, so I have to deduct it from my loan amount, right? So the first month or in the second month I will deduct my loan or my principal paid amount from this 10 lakhs. So I've deducted this my principal amount and I'll drag this. I will do it again, don't worry. As a concept, just see the last month. I've paid my EMI as 87,915, out of which my 726 was my interest, 87,189 was the principal, which is same as this. If I move one step ahead, I will get 0 as an output. So after my 12th month, I don't need to pay anything. So this is highly useful when you are creating an amortization schedule, either for any kind of a loan or any of the exotic instruments like mortgage-backed securities or a credit default swap, where you have monthly payment or a payment at a regular interval. You can definitely use this kind of an amortization schedule. Okay, I will explain this again, but any specific questions you have, you can type in your questions, please. Instead of raising hands, you can type in your questions, please. Quickly. Okay, I have a question says, how do you calculate loan amount for each year? Loan amount is already given. That's the only input which we have. Okay, that's the loan which I have taken, so I have to repay that. Loan amount you cannot calculate it. It's already given in the statement, or in the real life you already know how much you owe to someone, how much you owe to bank, or how much you owe to a company, or how much you owe to individuals, or how much you owe to companies. That's already given. That's a liability on your part. The thing which you are trying to find out is how much I have to pay each month, out of which what is my interest payment and what is my principal payment. This is useful. This is useful. This is useful when I have to make a prepayment. So that's usually useful. So more the number of years, the higher the interest rate. Okay, I have a couple of other questions. No, I have. No, yeah, there's a question. Did you apply direct formula to calculate loan amount each year? So that's a formula. It says that every month I will pay some principal amount. Okay, and in the next month I will deduct that amount from my previous month's loan amount. So here I've deducted the principal which I have paid back, which is E11, from B11. So that's a direct subtraction. There's no other formula as such. I hope that answers your question. Then there is a question says that what if interest rate is changing every year? Okay. Uh, if my interest rate changes every year, then my EMI will change. And then I have to make some arrangement. So if my EMI changes, so if let's say my interest rate, or let's say next year my interest is 8%, 8%, then I have to calculate EMI on the basis of that, which is PMT this divided by 12. My number of period then would be 11. Okay. Present value would be the remaining my loan amount. Then my F is 0 and my end of the period I will pay it. So my EMI would be 87,058 and then I will do my calculation on the basis of this value. Since I have not made this my PV negative, my EMI was coming negative. So now I've made my PV negative, so my EMI comes positive as such. And then I will make interest and principal amount based on that. So that's the basic idea. If my interest rate increases, accordingly my EMI will increase. Accordingly my payment will also increase. Okay. Okay, I will repeat how did I divided EMI into interest and principal. Okay, 1 second. If we take a study loan, there is another question. If you take a study loan and start paying the EMI after say 2 years, everything remains the same. Because you are going to pay after 2 years, so there is no penalty as such. If there is a penalty, then you just have to include that in your loan amount. Everything else remains the same as such. Okay. Uh, okay. Uh, EMI. So there's a question called as can you split? How did you calculate EMI or how did you split? So EMI every month have calculated. Now this from every month. Every month. Okay. Before that, there is a question. Let me read it out. Monthly payment of a loan is cheaper than payment at the loan period. Monthly payment, I have just segregated it. I have not paid the entire loan amount. This is for my understanding purpose that how much interest I am paying and how much principal I am paying. The broad based category. So let's say you okay, so this thing has two ways application. So for example, when you calculate the income tax for your month for your year, there is a section where you can declare your interest payment and you can get a tax exemption on that. So this table is usually useful because you will calculate this interest for entire year, okay, and just and then you have to declare this interest payment and you will get a document from the bank saying that you have paid so and so amount of interest to get a tax exemption. So banks will calculate like this. So that's one application. Second application is your prepayment. Okay, so when you have a longer horizon, this is for the 1 year. So over here you are paying a lesser amount of interest compared to your principal. But when you are considering a home loan where you have a loan of let's say 50-60 lakhs and duration of 30 years. So then in the first month or in the first couple of years, you have to pay exorbitant amount of interest. Okay, so there, if you have money or if you gain a handsome amount of bonus or uh, if you get windfall gains, then you can directly prepay to avoid the lot of interest payment which is happening with you or which you have to make as a part of your EMI. Okay, so in this case EMI, so I have calculated EMI using a function called as PV. Okay, and then based on my uh, formula, which is I have to make monthly payment which is of 10% divided by 12. Okay, so which is 10% divided by 12. I will pay interest on my loan amount, which is obviously this interest rate on my loan amount, which is on 10 lakhs. So which is 8333, which is 10% divided by 12 multiply my loan amount. Okay, so I will pay 8333. Now EMI is split into two components. One is interest payment and one is principal payment. So interest payment is I've already calculated, and then comes the principal payment. So out of EMI I will deduct this. So rest is my principal, which on the next period I will deduct it from my loan amount. So that's the basic premise of this. I also have a question says that in the study loans the interest rate gets accumulated for 2 years and then we start paying EMI. So basically interest gets accumulated in your loan amount. As and when you start paying your EMI, it will get deducted. So it will be treated like your loan amount. So let's say my interest for 2 years is 1 lakh. So I will add this 1 lakh into my loan amount and then the EMI will start as and when I start paying it. So that's the basic premise, that you basically add into my loan amount. But as far as I know, interest doesn't get accumulated. That's a more likely once you start earning and once you start, you have to intimate your bank saying that I will start my EMI from so and so date, and then they calculate the EMI and then you start paying it. That's pretty much. Any more questions you have? Okay. Now there are a couple of interesting things which is more like an application of this thing. So I will calculate quickly total interest which I have paid, which is equal to sum of the entire amount, interest amount. Same with the principal. So principal at the end I have paid 10 lakhs and I have paid a total interest of 54,990. Okay. There is a formula called as cumulative interest. So there is cumulative Aipmt, which says that how much interest I have paid between two periods. Okay. So there is only difference is start period and an end period and a type. Rest of the things remains the same like PMT. So I will start with my rate divided by 12, number of periods which is 1 multiplied by 12, PV is my 10 lakhs, my start period is, so let's say my tenure is this one and my last tenure is 812. I have paid at the end of the period and I'll close the bracket. It says I have paid total of 54,990, which is same as this. If I change the period, so let's say I have okay, so I will start my start period over here, end period over here. Start period is 1, end period is 12. I'll give reference over here which says G. Instead of putting this, I'll put G25 comma G or H25. Okay, I want to calculate interest for only 11 periods. Then my answer changes. It says 54,264. If I calculate interest, then over here it gives me interest as 54,264. That's a cumulative. Interest for only 3 periods, then 23,004, which is the sum of first 3, which is over here. So this is an interesting application. Same is with the principal. Everything remains the same. Everything remains the same. Rate, which is my 10% divided by 12. Number of years, which is 1 multiplied by 12. My present value is this. My start value, or start period is this, and the end period. And my type is 0 because I'll pay at the end of the period. It says for the first 3 months I have paid total interest or total principal of 2.40 lakh 742, which is the same figure over here. Okay. Uh, so this is an interesting application usually used when you are calculating or this is highly recommended when you're trying to assess whether you have to make a prepayment or not. Okay. Uh, the file is already shared. You can always see the file and have the formula because we are running short of time actually. I will or in case you have any specific doubts, you can always email me. At the end, I will share my email ID as well. There are a couple of other formulas or other interesting functions, which is one is rate function, which is to find out what is the interest rate. Okay, so I will find out rate. Okay, which is number of periods, which is over here, which is 1 multiplied by 12. Second says what is the PMT, which is my 87,915. What is my present value, which is over here. I have to make this negative, and again there is no future value as such. And at the end of the period, it says 0.83 per month because we have taken month per. We have taken in terms of per month. So we usually multiply this by 12 to get per year interest, which is same as 10%. Okay. So these all are auxiliary formulas or corollary from the same formulas. There is something called as Ipmt, which tries to find out in that particular the mention says that returns the interest payment for a given period. So within that one particular period, how much interest that I have paid. So what is my rate again? This is 10% divided by 12. Okay. Period, which is over here, which is 1. Okay. Number of periods, which is 1 multiplied by 12. My present value is something over here, and I make at the okay. It says in the first period I have made a payment of 8333. Okay. So over here I can give a reference as this as well. So in the first period I made a payment of 8333 interest. What if I want to find out how much interest rate instead of creating this entire table, I want to find out what is the interest payment I've made on the third period. If I write 3, it says 7001, which is this. Fair enough. Same is for the principal. PPMT. PPMT rate is 10% divided by 12. My period would be this. Number of period would be 1 multiplied by 12. My present value is this 10 lakhs, and which is at the end of the period. Okay. So in the third period I paid principal of 8914. So this is useful when I don't want to make this amortizing schedule entirely and I directly want to get the output. Okay. So that's the prima facie for this formula. Now there is interesting thing which is a FE schedule. Okay, FE schedule basically says that if there are multiple interest rates, so there is something called as FE schedule. It says the principal amount and what is the schedule of my principal growing or depleting. Okay, so let's say I have 3 rates, which is 8%, 9%, and 10% over here. So over a period of 3 years. Okay, over a period of 3 years. So there is no present value as such. This is a principal payment. So I have a question says that wouldn't the present value change for each period? So this is a PPMT is not a present value. This is a principal paid in that particular period. It is as simple. Then you convert into a present value, you may get a lesser value than this. Okay. FE schedule primarily says that if I have 10 lakhs over a period of 3 years, growing at 8, 9 and 10%, then what will be my final output? So I can either do something like this, which is equal to 10 lakhs. I multiply this with into 1 plus 8%. Then this will go again over here, and I will drag this and I will drag this. So my output is 1.294920 amount. Okay. Instead of that, we have FV schedule. I will write FV schedule. My principal is 10 lakhs. Okay, and I'll simply drag this my interest rates, which is 8, 9, and 10. Can you hear me? Can you hear me now? I think there was a intermittent interruption because of the internet. Can you hear me? Sure. I will start with FV schedule again. It says write FV schedule. Okay. My principal amount is 10 lakhs, comma, my interest rates, which is 8, 9, and 10%. I'll simply close the bracket. I'll press enter. This amount and this amount is the same. So instead of doing this activity, I can directly write FV schedule and get my output. Okay, fair enough. I've already solved this. If you have any specific questions, then you can always email me, or you can ask at the end of the session. If you in general haven't understood the concept, then you can question me now. The floor is open. We have one last exercise, which is for the distribution before we end our session. The floor is open for the questions, please. Fair enough. If you have any questions, then just email me. Yeah. Okay. In the FV schedule basically means my investment which grows at a different period. So if my investment 10 lakhs is growing at 8% in the first year, then 9% in the second year, then 10% in the third year, what is my cumulative output? Okay, so FV formula directly doesn't give me. So FV formula assumes that I'm growing at a fixed percent. Instead of I want to grow at a different percentage, then I have to use FV schedule. That's the only difference. I'll start with my principal and then I have to write whatever the growth rate in my interest rate. That's the premise. Okay. There is a function. Okay. It says that in PPMT, my PV value doesn't change because PPMT internally creates amortization schedule from the start. So that's why I've taken PV as 10 lakhs. Okay, so that's why I've not taken PV as 8.4 lakhs. PPMT formula internally, or which is not in front, calculates this entire amortization schedule, mind it, and then it gives me output at this third row or the fourth row depending on my time period. That's why I have not changed this PV for that particular period. If I had to calculate this PV, then what is the use of this PPMT formula? PPMT formula internally creates the schedule and gives the output. Okay. Now quickly we'll move to a final and probably the most interesting part of it, which is the distribution of a stock. Usually we hear that all the returns of the stock market is usually follows the normal distribution. We will try to see how, and there is only one particular thing which we are going to learn, which is the frequency formula. Okay, so over here I have taken the share price of Infosys. I have not adjusted for the bonus and the split. If you want, you can do it depending on when they have calculated the bonus and when they have done the split. Okay, I have kept it very simple. Since 2010 till yesterday, I have taken the share prices, the open price and the close price. I have calculated the daily returns. How do we calculate daily returns? Which is today's price minus previous day's closing price divided by previous day's price. And I will simply drag this. This will fetch me daily returns. Okay, what I am trying to find out, the standard deviation and whether it follows the normality, which is a standard distribution or standard normal distribution. Okay, I will find the total number of days. Total number of trading days would be count A, which is non-blank cells. Okay, which is I will take the dates. Okay, count A. I'll take total number of days. Control Shift Enter. Control Shift down arrow. It says there are 1774 number of total trading days. It doesn't take Saturdays and Sundays. So over here you can see there is no Saturday and Sunday as such. Over here you can see there is no Saturday and Sunday as such. So this 1774 is basically total number of traded days. Okay. Now to calculate the standard deviation of stock returns, there is a direct formula called as STDEV dot P, because we are calculating for the population. Had it been for a sample, there is something called as dot S. We will calculate for the sample. We will select the returns, press enter. It says there is the standard deviation, daily standard deviation is 2.40. To convert this into years, we can multiply this with square root of total number of trading days, which is 250. Okay. My mean over here is my average. Okay. Which is my mean returns, which is over here, which is 0.02, which is almost negligible, 0.02%. Okay. Now to find out the normal distribution, there is something called as mean, and then left side of the mean and the right side of the mean. So we are trying to find what is above mean, what is below mean. So above mean, what is the count? So there is a formula called as count if. This is my range. Okay, and my criteria is above my mean, which is over here. Okay, this is 922. I'll copy the same formula. I will just change the sign. Instead of this greater than, I will write less than. So there are 852 times, 851 times the return is below mean, 922 times which is above mean. I will show that again. The formula is count if, okay, which will take one condition. My range is my returns. If I don't write any sign and directly write the criteria, it will take as equal to. But I have to count how many times the return was above minus 0.02 percentage. So that's why I write greater than, which is into inverted commas. This M% will merge to mean. Same thing for the below mean, where I will write less than. Okay. Okay. Now for the distribution, I have to find out the various sections within the returns where it tells me that where my returns are. Okay, so over here for the standard distribution, there is something called as below 3 sigma, then between 3 sigma and 2 sigma, then 2 and 1, then 1 and 0. Okay, so here I have already defined the ranges. Less than 3 sigma, so I have to find out less than 3 sigma is how much. Okay, plus or minus 3 standard deviation, like we usually say it. So which is my mean minus 3 standard deviation, which is over here 2.4. So which is 7.22. I will simply drag this. Okay, I just have to change. Okay, I will make this constant before I drag this. I just have to drag this. Now first one was minus 3 sigma, then minus 2 sigma, then minus sigma, which is minus 1 sigma, then at the center, then plus 1 sigma, plus 2 sigma, plus 3 sigma. Okay, we will calculate this, or we will convert this into a 2 decimal digits. Okay, we have converted this to a 2 decimal digits. Okay, the last one is missing, which is above my 3 sigma. Okay, now I have to find out how many values are less than 3 sigma, between 3 and 2, between 2 and 1, between 1 and 0. Then on the positive side, between 0 and 1, between 1 and 2, between 2 and 3, and above 3. So there are different ranges which has been defined. Excel has a formula called as count if, but count if will count what is less than 2, less than 1. It will not define a range. So Excel has a function called as frequency. So frequency, okay, it asks me what is my data array. So my data array is my returns, and I will make this constant. Then it will ask me what is my beans array. Beans array matlab where I have to make the ranges. So my ranges are the distribution of the, or the calculated returns, plus or minus 3 sigma. Okay, and I will close the bracket. It doesn't solve the purpose yet. What I have to do is I have to select all the ranges. I have to enter the formula, and I have to press Ctrl Shift Enter. Then it will give me all the values as an output. I will explain this again. This is an array formula. This is an introduction to an array formula. That's what we are actually witnessing here. To find the array, or to find the ranges, there is a formula called as frequency. My data array are the returns part of it, where I am trying to find out or for which I am trying to create a range. I'll move up. My beans array are my plus or minus 3 standard deviation. I'll make this constant again. I'll close the bracket. This doesn't solve the purpose. I'll select all the ranges. I'll click on the formula, and I'll press Ctrl Shift and Enter. This will give me my distribution. I'll simply select all these things, paste it here as a special, and if I draw a graph of this, it says you can see that this is more like a distribution, a normal distribution, or a bell-shaped curve which appears over here. Bell-shaped curve appears over here. So this basically means that extreme ranges are 3 and 10, then 6 and 7, then 57 and 82, and most of them lies in between. So that means I have high kurtosis. High kurtosis, left, the tail part is very narrow, but it still goes into a negative part of it. The positive part of it, the negative part is very minimal. However, I get the positive part of it. The positive part primarily may be due to the split and the bonus, because as in when you split, your returns are maximized or losses are maximized because your share price reduces by half. Alright, so that's the basic contour, and we have tried to show that this is what the standard distribution looks like with the help of Excel. At least we can have a basic check whether Excel follows the standard distribution. As an exercise, you can do it on the multiple stocks. You can do it on the stable stocks like TCS, Infosys, HUL, Reliance, and you can also look at some of the stocks like DLF, Unitech, and then you see what kind of distribution it follows. So that's pretty much about this particular session. I am open to questions. Okay, how did I copy my formula? I didn't copy. I simply took this value, or I selected this value by pressing Ctrl C. I went to this destination, right click. There is something called as paste only values, and I pasted that. Otherwise, it will copy the formula. Okay, so I've pasted only values. So that's how I pasted my values over here, so that the formula doesn't get pasted over here. Any more questions? I am technically done with the session. This was just a flavor of various statistical, basic statistical and various introductory finance formulas. This can be extended into solving multiple issues related to financial modeling or an investment planning, or if you are creating any kind of an exhaustive model, then something of this can be useful. This frequency formula can be used anywhere. This frequency formula, so let's say you are a part of an HR, okay, and then you are trying to fit in a bell curve depending on whatever the ratings they have got, and then you have to find out worst rating how many people can get, best rating how many people can get or should get. So because most of the companies follow this bell curve, so anyone or at least one or couple of people will fall either into the highest bracket category or into lowest bracket category. There you can use this frequency formula, because in the organization you will have 40,000 50,000 of employees. So there is one practical application. Amortization schedule you can use for your loan purpose, okay. Time value of money you can use it anywhere for your investment purpose, or when you are taking up a project, when you're trying to calculate whether you want to take a project or not, when you're trying to calculate NPV or IRR. So that's where you can use it. Any more questions please before we close? Yeah. Okay. Okay, so in the FE schedule, what if the rate given for the first 3 months then changes for the, okay, so then you have to write number of periods over here, 1, 2, 3. For the first 3 years, it remains a constant. Since it's a month, so let's say for the first 3 months, it was for 8%. So you have to divide this 8 or by 12 and make this constant so that I can drag this. Then the rest 4 months, 4, 5, 6, 7. So this again is at a 9%. Let's say I will divide this 9 by 12 and I will make this constant, so and so forth. And then you can simply have FE schedule with all these interest rates. So more the number of period, more the number of line items you have to mention it over here when you are trying to prepare FE schedule. If you have so that's the idea about FE. So over here we have taken 3 periods over here. So that's what you are asking. For the first 3 months it remains the same, for the for the next 4 months it remains the same, and then it changes for the next 5 months. So that's what we have to write 12 different line items, and then we can write FE formula. Yeah. Any more questions? Alright, so if you have any more questions, then feel free to send me an email. My email ID is parth.parik@finshiksha.com, or you can give me a call at 90047 18889, or you can visit our website www.finshiksha.com. You can like us, follow us on Facebook or on Twitter or on YouTube. We keep uploading such kind of videos often. I hope you have liked this video. In case there is any specific feedback or you've not understood which is very specific, then do drop me an email. I will call you and resolve your doubts. I hope you liked this session. Thank you.